NOMI PRINS, look out for emerging market contagion. Turkey matters, and while the Turkish lira has temporarily stabilized, the worst is far from over. NOMI explains why. Even though summer technically lasts until September 21st, the reality is that after Labor Day, markets often snap into a hectic fall mode. A recent Reuters article notes that President Donald Trump's relentless America First trade push is hurting confidence in many countries. Rising U.S. interest rates are putting strains on emerging economies, and currency problems have hit crisis levels in Argentina and Turkey. When considering the markets over the last few weeks, and seeing how the Turkish lira in particular has fallen 40% against the dollar since the start of the year, I started thinking back to my first job on Wall Street. At the time, I was earning my degree in mathematics, and my senior thesis was on chaos theory. Chaos theory aims to find hidden order in a seemingly chaotic environment. This hidden order is often reflected in symmetry and in repetitive events. Within the field of chaos theory is a sub-theory called the butterfly effect. Built upon the math and science behind it, the main idea is that small changes somewhere can lead to drastic changes elsewhere over a given period of time. The shock waves of the butterfly effect and its ripples don't follow a straight path from one point to another. Instead, changes unfold in a more hectic or chaotic manner. For example, a hurricane in China can be connected to a butterfly flapping its wings in Brazil. Applying this theory to financial markets, what Wall Street was learning back then is something that matters even more to markets today: that associated data, numbers, and markets are all connected and not always predictable. With respect to markets, Wall Street discovered there are more than just mathematics driving behavior. Added into the market equation are factors such as human nature, the media, leverage, speculation, the cost of capital, and geopolitics, to name just a few. When the Turkish currency dropped by 20% alone in mid-August, it shocked the financial system. What we saw was the Turkish butterfly effect as part of the reason that Wall Street's major indexes have been jumping up and down over the last month. On August 13th, Turkish President Tayyip Erdogan started throwing his weight behind the latest trade war skirmish by declaring that Turkey would boycott electronic products from the United States. The very next day, investors saw global markets sink as the lira plummeted, causing more foreign investor capital to leave Turkey. The belief became that the lira was far from hitting its lows versus the dollar, and that the Turkish central bank wouldn't, or couldn't, raise rates enough to stabilize its currency. Turmoil and confusion had officially erupted in Turkey. While the Turkish currency temporarily stabilized, the worst is far from over. By August 23, the lira resumed its dive and continued to show signs of weakness. In many ways, President Erdogan did exactly what the Fed and the European Central Bank have done for a decade. He advocated for his central bank to lower rates and offer up cheap lines of credit. The major difference from Europe and the US, however, is that Turkey's central bank action led to more acute consequences. It caused 16% inflation and a seismic current account deficit because foreign money zoomed in for the good times and out for the bad. Loans were taken out in dollars and euros to finance companies and expensive projects across the country. Now, with the Turkish currency dropping and many of the country's loans coming due, outflowing money means that Turkey's problems will only get worse. Turkey will be forced to reckon with how to repay debt amid rising interest rates and a diving currency. In addition to the free-falling lira, Turkish companies are operating under the weight of an estimated $220 billion in foreign corporate debt. The harder that becomes to service, the more likely companies will default. Sweeping defaults in Turkey, should they occur, would not be an isolated event. On a global scale, banks around the world, particularly in Europe, still have exposure to Turkish corporate debt. Defaults would cause shocks across European banks, already beaten up by the Turkish situation, and ripple over to US banks, with greater exposure to Europe. Adding more to the economic pain, President Trump had handed Turkey a death sentence by doubling the aluminum and steel tariffs to 20% and 50%, respectively, that the US imposed upon imports from Turkey on August 10. According to one report, the United States is the fifth largest country, where Turkey exports its goods, and trade volumes amounted to $20.6 billion in 2017. While this might seem to be more of Turkey's problem and a tactical move by Trump, it is more complicated, and that Building from the butterfly effect, U.S. construction and engineering companies could see the cost of steel rise due to a lack of supply. That could induce them to cut American projects and American jobs to compensate. Why does this matter to you? If Turkish imports dry up, associated companies could default on their debt, causing negative impacts on the levels of stocks, some of which could be in your portfolio or attached to your 401k plan. The butterfly effect in Turkey could alter the financial weather in Kansas, Ohio, or Massachusetts. That's because major investors that have money tied into local Main Street economies have also invested in emerging markets, like Turkey. If those investors decide to pull their investments or stop investing in economies, the risk is that they could back away from stock investments altogether to protect their money, triggering a broader crisis of confidence. My colleague Jim Rickards has been on the front lines warning about how big names are increasing their cash allocations. Chaos could further such efforts as investors look for reduced portfolio volatility. As it stands, the crisis in Turkey appears to have more teeth and staying power. In part, that's because end-of-summer trading is thin, meaning rumors and fear play larger roles. However, it's also because Turkey has major geopolitical ties with the rest of Europe. As with Greece, those fears could travel throughout Europe and spread globally. Some already have. What Turkey symbolizes is larger systematic instability. Central banks don't like chaos. What we saw following the 2008 financial crisis was trillions pumped into markets to help the economy and to reduce market fears. With money at such low rates, governments could borrow for the future to pay for present costs. Corporates could do the same, as could consumers. The world became saturated in cheap debt. Because debt was so cheap, the interest paid by government and corporations was also low. That meant investors and speculators had to pile on more and more risk to get higher returns. This is what has translated into one of the major drivers of the bull market we're in today. But at some point, an impasse between debt and stability will be reached. As tension builds and markets remain volatile, questions will build around the Fed's pivotal decision, whether to raise rates or pause them, when it meets on September 25th. The Fed doesn't just look at growth figures, inflation statistics, and even jobs numbers. It undoubtedly is aware of liquidity and markets. If Turkey ignites what's already a looming debt crisis, the Fed may have no choice but to wait on raising rates. You should fear the emerging market debt bubble. Global debt has ballooned since the financial crisis as central banks have distorted markets and fueled debt bubbles in particular. A lot of the increase in global debt has come from emerging market economies, especially China. In fact, a record amount of debt has accumulated during the past decade, mostly in dollars. A large portion of that debt is therefore denominated in US dollars. That's why I've long argued that the first shoe to drop in the next crisis would likely be debt. Borrowing is not a problem when dollars are cheap. Low interest rates mean the cost of servicing that debt is low. The problem starts when the Fed raises rates or the dollar strengthens, even temporarily. The more the dollar rises, the more currencies and related markets fall. Dollar-denominated debt then becomes too expensive to repay or service as the dollar rises relative to currencies. Before long, default becomes the only viable option. This situation becomes more dangerous than even asset bubbles because debt is required to be repaid on a set schedule. If a country misses a debt payment, it could set off a chain reaction of defaults. That's why an crisis could quickly become a global crisis. In today's world of financial globalization, any remote crisis can become an international problem in seconds. That's the reality of today's markets. Obviously, it could also have major ramifications for your own finances and investments. How did we get here? Because of the Fed's rate hike cycle and quantitative tightening (QT) stance, the dollar has become much stronger. The dollar has risen 6.8% since late January alone. And that has put emerging markets under considerable pressure. Dollars are fleeing emerging market economies as investors are pouring into dollar assets and U.S. Treasuries. As the Fed itself has warned about such a scenario, if these risks materialized, there could be an increase in the demand for safe assets, particularly U.S. Treasuries. That starts a vicious cycle that only strengthens the dollar and weakens currencies further. In other words, emerging markets are being deprived of dollars at a time when they need them most. Enter Turkey. Panic spread throughout global markets last Friday as the Turkish lira plummeted after the Trump administration announced its plan to double tariffs on aluminum and steel imports. Already down substantially this year, the Turkish lira dropped as much as an additional 24% last Friday. Even though it is half a planet away from the US, the country could have a major impact. Like other emerging markets, Turkey borrowed a lot of money in US dollars after the Federal Reserve initiated its zero interest rates in the wake of the financial crisis. Turkey borrowed so much that its current foreign currency debt stands at more than 50%. Now, Turkey has a 15% inflation rate and a cratering currency. As the Fed is raising rates and the dollar is getting stronger, paying back that money is becoming much harder. The rise in the cost of debt payments means that defaults will become more likely. Turkey's central bank will need to raise rates to defend its currency, placing the government and economy in a difficult position. The lira has been holding its own these past few days, but this dynamic could take a long time to play out. Do not assume the crisis is over, and it may be some time before Turkey recovers. European banks with exposure to Turkey, along with U.S. banks connected to those European banks, could encounter serious headwinds, as will emerging market funds. Weakness in one emerging market economy leads to a loss of investor confidence in others. We've seen that movie before. But what is happening in Turkey right now shouldn't be terribly surprising, given Fed Chairman Jerome Powell's attitudes towards emerging markets. Going back to last October, his words offer a glimpse of what was coming. Powell was then just the number 2 guy at the Fed when he publicly articulated his outlook on tightening interest rates, the rising dollar, and the impact of both on emerging markets. He conceded that higher U.S. interest rates and weakening currencies could cause capital to return to advanced economies. But, unlike those that actually pay attention, Powell was not worried. He believed that the most likely outcome of that policy shift for emerging markets will be manageable. Powell's statement matters. He now commands the central bank, with the largest influence on assets in the world. Powell seemed to deny that the Fed is, as zero hedge sums it up, the major determinant of flows of capital into developing economies. Later on, as Fed chairman, Powell re-emphasized that position at an IMF and Swiss National Bank gathering in Zurich. According to Powell, there is good reason to think that the normalization of monetary policy in advanced economies should continue to prove manageable for IMS. Markets should not be surprised by our actions if the economy evolves in line with expectations. But Powell's argument misses a central point. What he left out was that it was the Fed's low interest rate policy, to begin with, that enabled countries to borrow as much as they did. If money is cheap around the world, higher rates absolutely matter. It appears he simply did not understand the inflows of cash, which explains why he wasn't concerned about the outflows. He believes that if the Fed raises rates, normalizes monetary policy, which it has been doing, and causes money to flow away from the emerging market countries, it is not his fault. Powell was not alone in his lackadaisical approach to emerging markets. Though the International Monetary Fund, IMF, has expressed concerns for years about the impact of a rising dollar and rates on markets, it recently said that reversal of rates would be orderly and will not take a toll on emerging markets' growth. Well, ask Turkey how orderly it has been. But capital flows won't be the only negative for emerging markets if the Fed continues hiking rates. We could also see dollar-denominated interest on debt become squeezed if the dollar rises on the back of higher rates. There is also considerable reason to remain wary about not just emerging markets, but governments and corporations with too much dollar exposure. How will the current situation affect Fed policy going forward? Despite Powell's previous comments, the current surge in the dollar gives reason to believe that the Fed won't tighten as quickly as it has said it would this year. A September rate hike, which seemed all but certain a short while ago, is now in doubt. Another rate hike right now, and a stronger dollar would only throw more fuel on the fire. Ultimately, central banks will intervene with additional easing if the crisis gets worse. That means more dark money will become available to prop up markets. That also means stocks could technically continue soaring on the basis of cash, or borrowed cash for an even longer period of time. Don't be surprised if stocks move higher from here. That is how dark money works to move markets.